Welcome to the today's webinar. So we have our speaker, today's speaker, Devashish Goyal, who will be going to speak on RSUs in the listed company expectation of the proxy and the advisory firms. So if I talk about the background of the Devashish Goyal, so Devashish Goyal is a chartered accountant by profession, and he post qualification, he is experience of 6 years. And right now he's associated with the ESOP Director Capita company. He is having its hands on the preparation of the scheme, and he has successfully implemented a scheme in around 60 of the listed companies also. Prior to that, he was working with a one of the big four named as a PricewaterhouseCoopers in Stat Audit Department, and before that, namely mediocre firm named as a Khimji and the Associates. So now I will be giving opportunity to the Devashish to take you ahead with the RSUs in the listed company and the expectations. So over to you, Devashish, now.
Thank you, Yash, for the introduction. Good afternoon to all the attendees. I would like to welcome you all in today's webinar on RSUs and listed companies, expectation of proxy advisory firms. Well, before we get into the details of the webinar, I would like to set the context, what we are going to discuss in this webinar. The first is we'll try to understand about the basics of RSUs. What are the significance of RSUs? That is going to be the second important part to understand. The next is going to be the role of proxy. Well, yes, proxy firms are quite active when it comes to getting any equity compensation plan approved. So we'll try to understand what kind of a role proxy plays. Then we'll try to understand the analysis of different parameters that is very important, how that should be implemented in order to get a nod from the proxies and then by the stakeholder. And then last but not the least, we will have 3 case studies, live case studies for you, which will make you understand what kind of plans were proposed by the company and what was proxy's opinion on those plans. So firstly, let's try to understand about RSUs. Well, what exactly RSUs are? Well, RSUs are a deep discount instruments that are available in India for incentivizing the employee. The point here to understand is RSUs is not a term that is being mentioned by SEBI regulator. However, it's a nomenclature that we have taken from the US market. So this is a widely used instrument. However, RSUs is not mentioned in the Indian regulation. Well, definitely it is an attractive tool to attract, retain, motivate, and retain the talent with the company. And why it is an attractive tool? Because it comes with a rock bottom pricing. That is the reason it is the most attractive tool when it comes to any equity compensation plan. Well, in terms of these are the stock options, that have an exercise price equivalent only to the face value of the company. That is the reason these are the most attractive component that is generally taken by the company while implementing the compensation plan. In terms of the importance, and you can say how the company take RSUs, well, yes, we can categorize this particular instrument after ESOPs. That is the most favored instrument that is generally taken by the company. I have got an example for you. Let's assume that the market price of the company on the grant date is rupees 100. The face value of the company being rupees 10. Now what RSU brings to the table is the exercise price is only rupees 10, which is equal to the face value. What it means that in order to become a shareholder of the company, the employee has to pay only the face value amount, which in my example is rupees 10. So in a nutshell, this summarizes what exactly RSUs is. Moving forward, let's try to understand what significance RSU bring to the table. When we talk about any equity compensation plan, there are 4 important stakeholders perspective that we need to keep in mind. The first definitely being the management, the second being the stakeholder or an investor, the third being an employee, last but not the least, a regulator. We have not captured regulator here. The reason is it is a when we talk about any equity compensation plan, it has to be transparent and in compliance. So in terms of bifurcating among the management, the stakeholder, and the employee, this is going to be the important point of discussion. Now, when we talk about management perspective, yes, definitely retention is a very important point for any organization. RSUs definitely bring that thing to the table, because here your employee gets a significant benefit in terms of per option wise that results into retention of the talent. Under the management categorization, if we look out why RSUs are a favored instrument, because it is a performance condition driven instrument. Now, what exactly this means? This point means that the vesting of the options are linked to the achievement of corporate or individual performance. Let's say by any condition, if the employee is unable to achieve the conditions, then those RSUs do not vest to such employee. That is the reason an RSU bring a performance-driven compensation plan to the table, which is a win-win situation for both the stakeholder as well as for the employee. Now, in terms of the management part, if we see, yes, definitely, shareholders definitely require a consent from the proxy in order to get the plan approved. It is important in terms of the proxy standpoint that sufficient facts are disclosed. Proxies firms are very rigid when if plan do not favor sufficient facts are not disclosed, then definitely they are against such plans and they definitely give a negative opinion. So it is important from the management standpoint, whenever a RSU is implemented, it should ensure that sufficient facts are mentioned in the scheme document as well as in the explanatory statement to get a positive response from the proxy as well as from the stakeholder. An important point here to understand is possibility of achieving of accounting cost efficiency. Well, over the years, there has been a myth that when we talk about accounting cost, RSUs comes with the highest cost, but it is not like that. Well, yes, RSUs per option can definitely have the highest cost, but when we take on a totality basis, the cost of an RSU could be lesser than the other equity instrument offered. The reason is in RSUs, lesser number of options are granted to the employee in comparison with the other equity compensation instrument. And when that amount is get multiplied by the cost per option, that is where the comparison comes into the play. So yes, there is a possibility that accounting cost can be controlled by the company while implementing an RSU plan. Now, moving forward, let's try to understand from the stakeholders' standpoint. Well, yes, number one, RSU brings a lesser dilution to the shareholder. The reason is the benefit per option is very high in an RSU instrument when compared with the other equity compensation. That is the reason the company is able to protect the dilution by implementing an RSU-based plan. Again, from the shareholder standpoint, the performance-driven instrument definitely brings a lot of things onto the table from the employee point as well, because if they are able to achieve the condition, that is when the vesting comes into the play. An important point here to understand is that stakeholders' point of view that RSUs do not bring skin in the game. That is not the case. If drafted properly, if implemented properly, it can bring skin into the game. It is important for the company to have performance-based conditions for vesting. If such kind of conditions are kept, then definitely it brings skin in the game. It is again dependent how well the scheme are placed. An important point from the stakeholder standpoint is RSUs definitely being the deep discount instrument. Here it brings sharing of past wealth to the employee. So here resistance can be seen from the stakeholders that we do not wish to give a past wealth to the employee. That's where a resistance can come into play. Now, the third and the most important perspective here is the employee standpoint. Well, as an employee, RSU brings the least investment when compared with other equity compensation plan. The reason is the exercise price is only equal to the face value that limits their investment into the company. So yes, for the employee standpoint, it looks very favorable. Another point to understand here is the employee can expect higher return in this particular case because they are always in the money. Even if the stock price decreases when the options were granted until the options were exercised, still they have to pay only face value. So definitely they can expect, a good return out of this investment plan. Again, yes, the market fluctuations is definitely protected in RSUs because it's only a nominal amount of face value that has to be invested by an employee into the company to become a shareholder. Now, moving forward, now let's try to understand what Proxy brings to the table when getting an approval for any equity compensation plan. Specifically, we are going to discuss their impact on an RSU-based resolution. Well, globally, proxies play a very vital role in terms of any outcome which requires shareholder consent. Definitely, proxies in India are also quite influential when it comes to any major resolution. And yes, it includes an equity compensation as well. What it means that the company which intends to implement any equity compensation plan, they need to get it approved by the shareholder. Then yes, RSUs is also required to be accepted by the shareholder. Now, when you talk about any investment, any equity investment plan, what the shareholder expects is the least dilution. That is what they ensure, and what value of their investment is getting exchanged when an employee exercises it. So the plan from the investor point of view definitely can see some resistance if it is against their thoughts. So it is important, that investors' point is also kept in mind when an RSU plan is being proposed. Well, investors, who are represented by proxy, what they need is they need an assurance that the benefit distribution which is going to happen to the employee is reasonable enough and transparent without giving unreasonable leeway to the management. So they want whatever benefit is being transferred or delivered from the company to the employee. This respective benefit should be reasonable enough. And an important point to understand is that as an investor standpoint, they they ensure that their capital is not at all at risk when an RSU plan is being implemented. Moving forward, proxies definitely have their say, which depends on case to case basis, how the company put their proposal in front of their shareholder. So their consent depends on how a plan is being proposed. Now, moving forward, we have got analysis for you on opinions by the proxy, which is a very important parameter to understand here. Specifically talking about the exercise price as one of the vital parameter of any equity compensation, proxies generally have a negative say when the pricing is open-ended. What it means that if the plan says that the power is with the board and the NRC to decide upon the exercise price, which can be anything between the face value to the market price, this has shown definitely some resistance in getting any equity compensation plan approved. Also, one more point to understand is proxies generally give a negative opinion when discounts of more than 20% are offered. So this has shown some resistance from the proxies. The positives here is that the plan should clearly specify that, yes, we intend to grant a face value options to the employee. Such kind of plans are definitely accepted. However, other parameters should also be kept in mind. The second point is in terms of the dilution. We have generally seen that excess of 5% proposal, or you can say a 5% of total pool, is generally seen as a negative opinion from the proxies. They prefer to have a lower dilution, and the range is between 2 to 3% of the paid up capital. So the company going for an excess approval could face a resistance. So it is important that dilution is also intact when any RSU plan is being proposed. The third important parameter in any scheme is the vesting condition. Well, if the scheme says that the power is with the NRC or the board to decide, then the company can see some negative resistance from the proxy. What they expect is that corporate performance should be mentioned in the scheme as well as in the explanatory statement, which requires the approval from the shareholder. So yes, corporate linked vesting condition can see some positive response from the proxies. Moving forward in terms of coverage, so if the RSU plan, what is proposed is only for few individuals or is not a broad based, we have seen that yes, proxies generally do not favor such kind of a plan. Vis-a-vis, if yes, it's a broad-based plan that covers from employee from all levels, being a junior level to the senior management, then yes, proxies are very positive towards such proposal. Again, it comes down how this is drafted in the explanatory statement. Moving forward in terms of the extension of plan, so what we have seen is that if the company who is proposing an equity plan and extends the plan to the employee of holding or a subsidiary company, which already has an existing ESOP plan or an RSU plan in place, then yes, the company, or you can say the proxy, can definitely give a negative opinion to such company proposal. Also, we have seen that proxies have given a negative opinion when the company intends to cover the employee of group or associate company. Now, let's see what is a positive response, what we have observed. If the company discloses the details of the entities to whom the options will be granted further, that is where a positive note can be seen. But it is also important that a clear justification is given by the management to the shareholder. Moving forward, in terms of modifying the plan, any equity compensation, specifically with respect to RSUs, if such kind of definitely can see a negative if power is not being given with a shareholder's approval. If NRC can make such modification, then yes, a negative resistance has been seen. But if any modification which is approved by the shareholder, then yes, it is definitely accepted by the proxy. In terms of the company who intends to increase their existing pool from, let's say, X number to a Y number, and if there is no justification offered for the incremental ESOP pool, we have seen that proxies generally do not favor such kind of a resolution. But yes, if in terms of what exactly they look at, they treat it as a new plan, and if they see if all the other parameters are well aligned, then definitely the plan can be approved by them. Here, now let's try to understand 3 case studies. The first case study, what I have for you is, there was a company who is into core business of banking and financial service. They had proposed an RSU pool worth of 10 crore units. It's a significant number, with a vesting period of 4 years. And they had captured the employee from one level below MD to the junior level employee. Then yes, it is a broad-based plan. And the important point to understand is the grants shall be performance based while the vesting was time based. So this was the plan that was proposed by the management, by the board to the shareholder. Now I would like to show what exactly proxy had given their feedback on. Proxies had said that it's a deviation from the market practice and the company group practice. In India, the banking schemes are generally market price driven. That is, Indian banks have not granted RSUs. So they were trying to set a context, a negative context towards RSUs as an instrument. What they have mentioned that NRC has got a flexibility for granting RSUs even to the leadership member. And it covers only 20% of the total company employee strength. The cost of the scheme was approximately 13,000 crores. That's again a huge amount in number. That benefit was proposed to the employee, and they had given a against vote for the same. However, the bank was able to get an approval from the shareholder. So the point to understand is, even if proxies have a resistance, even if they give an against vote, there is a possibility that the scheme can get an approval from the shareholders as well. It is very vital to understand how the schemes are drafted, how the explanatory statements are drafted. That is what stakeholders look at the end. Now we have got a second case study for you, wherein we have taken a pharmaceutical company, one of the leading pharmaceutical companies in India, with again an RSU worth plan of 60 lakh units, again a very significant in number, with a 3-year vesting period, covering the permanent employee as well as at the directorship level of the company and its subsidiaries. Well, the plan had a combination of both time and performance-based vesting. Proxies had given some pointers which didn't go well which didn't go well in favor of the company. The proxy said that the exercise price is open-ended and the power is with the committee to decide. So as I mentioned earlier, it is very important by the management to prepare a scheme which says that the exercise price is going to be the face value. Proxies do not encourage any open-ended schemes when it comes to RSUs implementation. The next point what they have mentioned is that it is a significant discount to market price and it protects pay at risk. That means the investor money is not used in a proper way, and that is where there was a resistance shown by the proxy. There was again no clarity on the performance matrix for vesting. So like I mentioned earlier, it is very important that corporate performance condition should be clearly laid down by the company in the explanatory statement. Another point what they have observed is that maximum capping of options. So that was also not clearly specified in the proposal that was given. Yes, as mentioned, the company got an against vote, and again the shareholders again the shareholders did not approve this respective plan, and the plan got failed to be implemented at the company level. The third and the final case study we have for one of the leading IT companies in India. The company had proposed a pool of 27 lakhs, 41,000 options, with again a vesting period of 4 years. They intended to cover the employee of the company, including subsidiary and associate, through secondary acquisition of shares by the trust. Proxies said that we don't have concerns with RSU scheme. However, there is no maximum capping of stock options. This is a concern in the scheme. That's where proxies gave a negative opinion in this respective plan. The second point, what they observed, that associate companies coverage could be more clearly specified in the scheme or in the explanatory statement proposal, because since there was no clarity whether the associate is in terms of related business or not, proxies gave an against vote. However, the company was able to get its plan approved by the shareholder. In a nutshell, just to summarize things over here, if proxy give a negative opinion, it doesn't mean that an RSU plan cannot be implemented. It is the shareholder who take a final call whether the plan is to be approved or not. It is very important that we frame a policy which ensures that there are lesser resistance shown by the proxies. Now, the key takeaways from this webinar is that yes, most proxy firms take equity compensation from the governance point of view, and it is very important by the company who is intended to implement such plan that governance is taken into the account and it is complied very well. What our experience shows that yes, issuer companies definitely have a strong rationale for what they're proposing and are able to express their objectives, then yes, proxies do agree. So it is very important that companies who are proposing, their objectives are clear. Then next, it is very important that all the performance-based vesting conditions are clearly defined in the scheme document. rather than giving a discretionary power to the NRC or board to decide. Here, it is again very important from the company standpoint that they approach to the proxies proactively rather than responding to the decided view, which is possible with a proper planning at the conceptualization stage. So it is very important for any organization who intends to implement an equity compensation plan that at the time of making a plan, all these thoughts are well and well thought of basis which a plan is proposed to the shareholder. So with this, we sum up our today's webinar. And now we would like to take questions from all the attendees.
So thank you, Devashish. That was a very great session. So now I would like to take the query. So I will repeat the query. So first query was from Humaira. So the query is, hi, can you please elaborate the meaning of the proxies and who all are included and excluded?
Okay. Well, when we talk about proxies, so these are the institutional firms who give their opinion in getting any resolution approved. So share investors who rely on the proxies for getting a plan implemented. That's where proxies read all the scheme parameters, and accordingly the plan is being approved by them. In terms of inclusion, so yes, they have to be registered with SEBI. So in India, there are 3 firms who work as actively advisors in terms of proxy. One is IIS, second is SES, and third is IRSPL.
So thank you, Devashish, for answering this query. So now next query is same from the Humaira only. So he's asking, so do they act as an agent intermediary between the company and the shareholders?
Well, yes, they do act as an agent between the company and the shareholder.
Now, next query is from Harit Shah, and he is asking, in any company, if promoters hold a high shareholding, it will be easy to get enough votes for the scheme to sail through at AGM.
Yes, absolutely. When we talk about any equity compensation plan, it requires a special resolution to be passed. That means a minimum voting of 75% to be in favor of any proposal by all the members who are attending that respective meeting. So yes, if it is a promoter, you can say a significant holding by the promoters, then yes. Yes.
So now in continuation to that query, where that person Harit Shah asked that it would be easy to get the enough votes to sail through the AGM. In continuation that he was asking, and this is even possible if proxy advisor given against recommendation.
Well, yes, like I mentioned, proxies do give a negative opinion. It is on us how we respond to their concerns. So that is possible. We engage them at an initial stage that we are intending to implement an RSU plan. We can take their thoughts and basis which we can get a plan approved by them.
So well addressed, Devashish. Now next query is from Ritesh Thakkar. He is asking, in case study 1.2, vesting and exercising point not clear. Kindly share examples as data.
Okay. Can you please repeat the question, Yash?
Sure, Devashish. In case study 1.2, vesting and exercising point not clear. Kindly share example and data.
Okay. See, there are a couple of things, we can say couple of periods that are very important to understand. The first is the vesting stage and the second is an exercise stage. So vesting is a stage which gives a time period for an employee to fulfill all the conditions in order to get the options vested. Once the options are, you can say, vested to an employee, it is on them to convert into the shares. Then it brings exercise period into the table. So the difference is a 4-year vesting period wherein the employee performs for the company. If he's able to achieve the targets, then he has another sufficient 3-year or a 4-year period to convert into the shares.
So now Devashish again query from Humaira, and he's asking, what does performance-based vesting includes?
Will the performance base can include a couple of things. One at the corporate level, the company can implement conditions like if we are able to achieve a target of, let's say, EBITDA level of 2x, 3x from the date of grant, the company's PBT, shareholders return, all those things are the corporate financial parameters. That is where the vesting can be linked for such RSU based plan.
Thank you, Devashish, for answering this. And next query is from Ruchi Khanna. She's asking, please share views on RSU plan with time-based vesting.
Definitely we have seen a resistance when it comes to a time-based vesting because it is against the investor's interest. Again, RSUs in a nutshell is the deep discount that is offered at an initial stage. Your employee is always in the money. The investor expects that whenever an equity compensation is offered, the risk and rewards are shared between the employer and the employee. So in order to cap that, we have seen definitely a negative resistance. We have seen a resistance from the proxies when it is a purely time-based instrument in case of an RSU.
Okay, thank you, Devashish. And last query is from Humaira. Also, in case of companies in UAE, what is the process and procedure in an unlisted company to issue ESOP?
We can discuss this because it's a global plan. So maybe we can take this query separately, Humaira. You can write it down this particular point. The global plans we can discuss separately. Yeah.
And another query from Kenan. ESOP, what are the tax implications?
Okay. See, basically, ESOPs are an instrument that are given basically at a market price or a certain discount to market price. It could be 10% or a 20%. When we compare it with an RSU, RSUs is the most deep discount instrument that is available. That means the exercise price is the face value of the company. So RSUs bring the deeper, you can say the deep discount instrument in comparison with an ESOP at market price or a 10-20% to market price. In terms of taxation, in either of the instrument, there are a couple of legs of taxation that comes into the play. The first taxation is when the employee exercises it. At that point of time, the employee has to pay a perquisite tax. Now, this perquisite value is computed based on the benefit he has earned from the exercise price up to the price of the company when the options were exercised. So yes, in case of an RSU, you can see a significant perquisite tax to be paid in comparison with an ESOP. The second leg of taxation will be when he sells those shares in the open market. So a long-term or a short-term capital gain will be applicable to the employee.
So next query is, why will management issue ESOPs and not RSUs?
Okay. The point to understand is in case of an RSU, the company is able to protect its dilution, whereas ESOPs comes with the highest dilution to the company. Number one. The second is RSUs are a performance-driven instrument, whereas ESOPs is more of a time-based instrument. So when the company intends to protect the dilution, vis-a-vis they want company to grow significantly at an aggressive level, RSUs are the plan that is generally considered. The third point over here in terms of comparison is, in RSUs, a larger chunk of employees can be covered, vis-a-vis since dilution being a constraint, ESOPs cannot be a broad-based plan.
So now these are the only queries. So we will wait for another 10 minutes for any further queries. And I am seeing that there is a hand raise from the Hiru Mir Chandani. So Hiru Mir Chandani, it is a request from our side. If you can type your query in the chat box, it would be quite easy to address the query. So next query, Devashish from Humaira, only in case of unlisted company where shares are not listed, how shall the employee know whether ESOPs and RSUs are advantage to them or not?
Okay. See, now specifically talking about at an unlisted company level, valuation plays a significant role. So the company has to get a company value done, basis which again a valuer has to be a registered valuer for determining the company share price. That is where an employee can see the growth of the organization, be it an RSU or in any equity compensation plan.
So Devashish, we do not have any queries. So we are just waiting for further queries for another 10 minutes.
Sure.
So if anybody is having any query or facing any issue during this webinar, then you can write your query in the chat box. We will be more happy to address them. हंसा रहा है मेरे को देवेश वो जिगर अजिंक्य Harit Shah, are RSUs or broader ESOPs better option in your opinion?
Well, yes, RSUs are generally implemented by the company who intend to cover the employee from all levels, be it from a junior level or to the top management. So RSUs is a broad-based plan because it controls the dilution. The benefit per option is significantly higher when compared to ESOPs. So yes, RSUs is definitely a broad-based plan.
So last query from Ritesh Thakkar, what is the percentage of perquisite tax applicable in RSUs?
Ritesh, any equity compensation instrument, the perquisite rate is dependent as per an employee salary slab rate. So if an employee falls under 20% bracket, so he has to pay 20%. If someone falling at the highest bracket, then they have to pay tax accordingly. So it forms part of the salary, basis which the tax rate is computed.
In ESOP, it is 33.9% from the Ritesh Thakkar only. Perquisite tax percentage.
Like I mentioned, the tax rate depends as per the salary slab rate. So if someone falling at the highest bracket, then 30 plus surcharge. Someone falling at a lower bracket, then accordingly the tax will be computed. Be it any instrument, be it an ESOP or be it an RSU.
So thank you, Devashish. You have well addressed all the queries. So I am requesting if anybody will be having any further query, then you are most welcome to write us. I will be sharing the coordinates, email ID, as well as the contact number. So you can write email to us. We will be more happy to address. So Devashish, if one last query you want to take, will RSU be eligible for bonus stocks?
Well, yes, we cannot, Ritesh, exactly link it with bonus stock. See, here it depends what is the objective of the company. So it again depends whether any compensation plan, what the company is implementing, whether it forms part of the total rewards or it is over and above the rewards. That is how it is treated. So it is not linked with a bonus stock, Ritesh, but it is more on the total reward strategy what a company has. Yes, do we have any other queries or we can?
No, Devashi, this was the last query. Will RSU be eligible for the bonus stock? So you have addressed it.
Okay, so just I would like to thank you all the attendees who have taken the time and attended our today's webinar. So we have been able to successfully get the plans approved by the proxy. So if you wish to definitely take our expertise, then you can reach out to our website and accordingly we can take it forward.
So thank you, Devashish.
Thank you,
It was a
everyone.
very great session.
Thank you, everyone. Thank you, Yash.